In the summer of 1720, shares of the South Sea Company, a British joint stock corporation holding a monopoly on trade with Spanish South America, rose from £100 to £1,000 in 8 months. Then they fell back to £100 in 8 weeks. Thousands of investors, including members of Parliament and the aristocracy, were ruined. The South Sea bubble remains the archetype of speculative mania. The South Sea Company had been created in 1711 not primarily as a trading company but as a mechanism for managing Britain's national debt. It assumed responsibility for approximately £10 million of government debt, receiving an annuity from the government in return. In 1720, it proposed an elaborate scheme. It would take over virtually all of Britain's national debt in exchange for shares. The scheme required convincing debt holders to exchange their government bonds for South Sea shares, at prices that were rising rapidly. To sustain the price rise that made the exchange attractive, the company used its own capital to buy its own shares, bribed government ministers, and issued shares on credit, allowing purchasers to buy with minimal down payments. The mania spread. Dozens of other bubble companies appeared, selling shares in projects to drain the Red Sea, to import jackasses from Spain, to make square cannon balls. One prospector simply offered shares in an undertaking of great advantage, but nobody to know what it is. It raised £2,000 in one morning before the promoter disappeared. The collapse came when confidence broke. In August 1720, the company moved to suppress the other bubble companies under the Bubble Act, partly to protect its own position, partly because they were diverting capital. When those companies collapsed, investors who had borrowed to buy South Sea shares needed to sell to repay loans. Selling cascaded into collapse. The South Sea bubble exposed a problem at the heart of joint stock company finance, the separation of ownership from information. Shareholders had no way to verify the company's actual trading operations, revenues, or prospects. The company's value rested entirely on expectations that the company and its promoters had strong incentives to manipulate upward. The debt-for-equity conversion scheme was mathematically incoherent. It could only work if share prices kept rising. Rising prices attracted more buyers. More buyers further inflated prices. The scheme required that the stock price never fall, which is to say, it required that it always fall eventually. Government corruption was central to the bubble. The company's directors had bribed ministers and members of Parliament with shares allocated at below-market prices. When the bubble collapsed and Parliament investigated, the resulting scandal implicated some of the most senior figures in government. The First Lord of the Treasury was imprisoned in the Tower of London. The deeper problem was the absence of any framework for corporate disclosure. Investors were buying claims on future profits from an enterprise they could not inspect, based on projections they could not verify, from promoters whose interests were diametrically opposed to theirs. The legal and informational infrastructure of financial markets did not yet exist. The immediate response was the Bubble Act of 1720, which prohibited the creation of joint stock companies without a royal charter. The act was passed, ironically, at the peak of the mania, partly as an attempt by the South Sea Company to suppress its competitors. It remained in force for over a century, retarding the development of corporate enterprise in Britain. Robert Walpole, brought in as First Lord of the Treasury to manage the aftermath, refused to cancel the fraudulent conversions or fully restore investors' losses. He negotiated a compromise. The Bank of England and the East India Company absorbed some of the South Sea Company's obligations, and a partial restitution was made from the estates of the directors. Walpole's political genius was in managing the investigation. He limited the inquiry sufficiently to protect the most senior political figures, including, apparently, some members of the royal family who had also profited, while providing enough accountability to satisfy public anger. The settlement was widely seen as inadequate. The longer-term solution was institutional. Over the following century, corporate law developed to require disclosure, limit liability, and clarify the rights of shareholders. The financial revolution that accompanied the South Sea bubble, the development of government debt markets, joint stock companies, and financial intermediaries, continued despite the crash, but on a more regulated basis. The immediate economic damage was concentrated among investors, many of whom had borrowed to buy shares. The credit contraction following the collapse caused a brief but severe recession in Britain. But Britain's underlying economy, its manufacturing, trade, and agricultural base, was not fundamentally damaged. Recovery was relatively swift. The political consequences were more lasting. The Bubble Act suppressed joint stock company formation for a century, forcing British businesses to operate as partnerships. This may have slowed the mobilization of capital for large-scale industrial enterprise during the early Industrial Revolution, though historians debate the magnitude of this effect. The South Sea Bubble entered cultural history as a warning against speculative excess. Charles Mackay's Extraordinary Popular Delusions and the Madness of Crowds, published in 1841, made it the exemplary case of mass financial hysteria. But the bubble also demonstrated that financial innovation, the joint stock company, tradable shares, the national debt, survived its own worst excesses and continued to develop. The pattern the South Sea Bubble established has recurred in every subsequent financial mania, a genuine innovation or opportunity, followed by speculative excess that disconnects price from value, followed by collapse, followed by regulation that attempts to prevent recurrence of the specific failure while leaving the underlying dynamics intact. 3 centuries of financial history are, in part, variations on this theme. The patterns repeat. The faces change. The cost is always borne by those who had no say. Economic Crisis Explained. 2026.